today we'll finish up the pricing examples. So last class it was a little frustrating because we stopped right in the middle of it, and you're probably thinking, wow, that was kind of complicated, a lot of steps. But we'll finish that up today, and then I'll work another example so you can see the full process all in one video. And this brings up this whole issue of insurance pricing and regulation. So there's an article I want to walk through. It's an old article because I have not been able to find a better one recently, but the issues in it, it's actually fairly interesting because the time it was written was right in the middle of some quite a bit of upheaval, especially in California. So in that context, it's very, very interesting, and it's still very current today. It really hasn't changed that much. I'll bring some of it up to date and what we know about what's going on in various states, but it's still very, very current. And then if we have some time, we'll talk about the difference between retention and transfer when it comes to insurance. There's a continuum. We think in terms of insurance as individuals, and the insurance we buy, which is mainly risk transfer. We're actually transferring our risk to State Farm or Allstate, but we'll see that there's a lot of insurance that's much closer to the retention side. Last time we had a company that their current year premium was $400, and they had an underwriting gain of 10. And so what we did is says, okay, we're going to project next year. And so on the claims, we just had to increase it by 1 plus the frequency and 1 plus the severity growth. So we actually linked those two on a formula. And I want to extend it out so you can see that formula again. So we took last year's claims times 1 plus the frequency times 1 plus the severity growth. That's the growth in frequency. The growth in frequency, frequency could be 0. It just depends on driving habits, miles, cars, how many cars are insured. So that's the frequency. The severity will probably grow just with inflation, but even more if auto parts, the type of materials used in cars, the technology in cars, if that's growing faster than general inflation, then the severity will be higher. If speed limits have changed, if the types of cars being driven has changed, all of that can have impact. You don't have to worry about that because I just tell you that it's 3% and 3.5%. We do the exact same thing for LAE. We take the prior year's or the current year's LAE and multiply it by 1 plus the frequency times 1 plus the severity. So the growth in frequency, the growth in severity. Notice exactly how I do the formula. We're actually interacting these two, which makes sense. If severity increases and frequency increases, there's a combined effect. So that's the reason I'm not just growing it by 1 plus 5%. I'm doing it 1 plus 3% times 1 plus 2%. I'm putting them both in there. And then the final one, expenses just grows 2.5%. And when we do that, I don't have a premium in here. This is what we're trying to figure out, this number right here. We didn't know what it is. I just plugged 400. If we had 400, we would have had an underwriting loss. And then remember what we did after that. So we now want to say, okay, we're going to spend $303.82 in claims. However, we know that those claims on average will be paid out over 6 months. So some of it today, some of it a year from now, but about half a year. So what is the present value of $303.82 for 6 months if our discount rate is 4%? Remember, we use the investment return as our discount rate. And so we just take how much we expect to pay in claims divided by 1 plus 4% raised to the 0.5, and we do that all the way down. And then we sum that. And so the sum of the discounted claims, LAE, and expenses was $404.34. The sum of the undiscounted was $412.35. So the difference in those two is going to be our investment income on float. All right. We will also have, and one thing I just like to add is investment income on beginning net worth. I like to add that in. This is the part where there's so many different ways that we could do this. This is the way I do it to keep it simple. It's actually a little more complicated than that. I'm just doing it in a very simple way, so you're at least thinking about it, that there's this product has a retained earnings, has a net worth, and so we can still earn some investment income on that. So what is that? That beginning net worth is 133. Our investment income is 4%. So we'll make an extra 5.33 in investment income on our beginning net worth. So our total investment income is going to be the sum of those two. So our investment income is just going to be 1334. Our required premium, the surplus, is 3-to-1. So if our premium was 400, then our required net worth is 133.34. So our average capital requirement, I'm sorry, I put the investment income in the wrong place. So investment income is 1334. So let's look back. I just gotten on the wrong line. So our investment income is 1334. So our investment income is our underwriting loss plus our investment income. We made $1 in net income. So just follow down. Our premium, we don't know yet. We're going to solve for that, but we'll say it's 400. Our claims, our LAE, our expenses, that gives us an underwriting loss of 1235, assuming that premium's correct, which we know it's not. Our investment income, we just figured that out. It's the difference between the present value, the difference in our claims, LA, and expenses, and the present value of that. Plus, we'll add a little bit of investment income for the beginning net worth. So there's our net income. So that's our investment income. So our net income is 1. Our required capital is 133. So we'll take the average of our beginning and ending net worth. It's obviously going to be 133 here because I have the premium the same, so required capital is the same. The last thing I do, which this is maybe a very UTSA thing to do, but other companies might do it as well, is what we want to say with this product is that's our net income 1. However, if our required net income, our required capital increases, we are going to count that as a charge against our net income. So we're going to take our ending net worth minus our beginning. Now here it's going to be 0 because I'm using the same premium, but if our premium increased to say 420, our required net worth would have actually increased by 667. Alright, so I'll keep it at 400, but so our net income, we're going to take our net income and subtract the increase. Now what's the argument there? The argument there is this product has expenses, but it also requires us to hold more net worth. There's a capital charge. So we're essentially going to penalize this product for requiring us to hold more net worth. So our return on capital then is going to be the 1 divided by our average capital, and that's only 0.75%. All right. I'll walk back through this entire thing again. We need a 7% return. So here's how we figure that out. We're going to say, and over here what I have is the difference in our required return, 7%, minus a 0.75%, and I'll multiply it by 1,000,000 just because there's a rounding function in the goal seek, and you'll see. So I'm going to run goal seek. I'm going to do data, what if analysis, goal seek, and what I want this difference to be 0 by changing my premium. So there's my premium. So let's go back and let's look at this again and walk through the whole thing. They're telling us that our premium needs to be $412.73. Our claims and LAE do not change. The present value does not change. So this part of the math does not change. Our underwriting, we have a small underwriting gain. Our investment income doesn't change either. That's going to be exactly the same because our investment income is based entirely on our claims undiscounted versus our claims discounted. So nothing changes. The net income will be higher by $12.73 because we increased our premium. Our required capital does increase because our premiums are slightly higher. Our average capital is going to be slightly higher. And we had additional required capital of $424. So I'm dinging them there. I think that's overly conservative, but it's somewhat my background at UTSA, where capital was just such a high precious commodity. We want our companies to cover that extra capital. I do think it's probably a little excessive. So when we do that, we take our net income, which is our underwriting gain and investment income. We're then going to subtract that increase in net worth, and that gives us 948. You take 948 and divide it by the average capital, and that gives you exactly that 7%. All right. So all set up, all makes sense. So our premium minus our expected losses, we got that by increasing last year's by the increase in severity and frequency, or by the inflation. That gives us a net income. Our investment income is difference between undiscounted and discounted numbers plus 4% on that beginning net worth. You get the average. And you want to use the average for your return on equity. You don't want to do return on equity on the beginning net worth. You want to do it on the average. We get a change in required capital, which is probably the strangest thing I do. I doubt most companies do that. I add it in because I want you thinking about in terms of how firms really think about capital. Capital is something you hold because of the risk of the product. Remember, I talked about that earlier, how homeowners insurance has so much required capital, and you just got to set it aside. So we're giving this product benefit for its capital that it's retained historically, but if they have to retain more capital, we're going to penalize them for that extra $424. Now next year, if they have that extra $424, they can then earn income on that. So I'm giving them some credit for it in future years, but I'm dinging them this year for increasing how much capital we have to put aside. And then that gives us a net income less the required capital. So we've got all of the pieces. So now what I want to do is work an entirely new problem, and I'll bring it in. All right, so I want to work a problem. This is from, I think, last year's exam. We'll see. It's a little bit different how I have it set up, and I may not do this on the final given that you have access to Excel. But here's a company. They charge premiums of 100. Here's their claims, 14. Claims 66, LAE 14, underwriting expenses 18, 14, 18. So that gives you 100 minus those gives you 2. This is the current year, and here's the numbers that tell us what it's going to look like going forward. So let's work on this. So you put the current year in there, you put the prior year in there. We're going to have premiums, claims, LAE, expenses. That gives you the underwriting gain. What else do you know? So just what else do you need? Let's just put the rest in there. We have investment income. That's going to give us net income. We have required capital. We have the average required capital. So you just get all the pieces in there. You got the change in required capital, the Professor Sweet thing. Then you have net income less the change in required capital, and then you have the return on equities. So those are all our pieces. So let's put in the numbers: 100, 66, 14, 18. Then our underwriting gain is our premium minus our claims minus our LAE minus our expenses. So that's 2. So let's start with the very first one. So, I'm sorry, you might hear my neighbor. He's always in his backyard talking really loudly on his cell phone. He's probably telling the guy on the phone that this guy's talking really loud in his office, you know, so we're talking over each other. So ignore him. He's not talking about P&C insurance. All right, so this stuff we don't need for this year except for the required capital. Required capital is just the premium divided by 3. How do we know that? Because we just know the required capital is right here, is 1/3 of premiums. Remember we said that's a pretty famous way that insurance companies have been operating over many decades. So that's all you need on the current year. So let's do the next year. So let's start with claims. What do we know about claims? They were 66 last year. I'm sorry, that's not prior year, that's next year. They were 66 last year. What will they be this year? They were 66 this year. What will they be next year? So we take that 66 times 1 plus 0.038. See over here, that's the increase in frequency, times 1 plus 0.03. That's the increase in severity. So that gives us our claims. Then we do LAE the same way. We take the 14 times 1 plus, you see for LAE, the growth in the LAE 3.8%, and 1 plus 2%, looks like that's just inflation. So there we've got the next year LAE, and then for expenses, we only have one item on expense, just the inflation on expenses. Growth in underwriting expenses 2%. And then the underwriting gain, again, is going to be our premium minus our claims, minus our LAE, minus our expenses. Now, you notice the way I used to this problem is I gave 2 premiums and you had to tell me which one was the right one. I'm not so sure I'll do that on the final. I think you might be able to figure that on your own. But let's try the higher number, 110.2, just to give us a starting point. All right, investment income. So to get the investment income, we need the present value. So what do we need for the present value? So we say the timing is 0.5. That tells you here, claims timing paid out over the next 12 months evenly, so that gives you an N of 0.5. If you use an N of 1, 12 months, that means you paid all the claims exactly in 12 months, 100% exactly 12 months. But we're spreading it out over 12 months, so that gives you an N of 0.5. And that's the same for expenses and LAE. And our investment return assumption is 3.5%. So what does that mean? It means we use the same formula over and over again. We take the full year's LAE divided by 1 plus 0.035 and raise it to the 0.5, and we do that all the way down. And so for the investment income, we're going to do the sum of losses, LAE, and expenses. And then we'll do the present value sum of losses. So losses LAE, we'll take sum of these, the undiscounted ones, and then we'll do the sum of the discounted ones. So the difference is 177. Remember, that number is the same no matter what premium we have because there's no impact on your premium. Then we have investment income on beginning required capital. And so here we take beginning required capital, 33.33 times 0.035. 0.035, remember, is our investment return. And so that gives us total investment income. We just add those two together. They look like the same number, but they're not. It's 177 and 117. So there's our investment income. So we can put that on this line. So our net income now is 939. What's our required capital? Required capital is just premiums divided by 3. The average required capital, I'm taking everything to 2 decimal places. You'll always have, if you're doing this in Excel, and that's why I said make sure you're doing this in Excel along with me. I would not round, so I'm using 2 decimal places, but it's actually much more than that. Alright, so the average required capital is just those 2 numbers added together divided by 2. And then the change in required capital is just the required capital this year minus required capital the previous year. So our net income less required capital is $599. What is our return on equity? We take the $599 divided by the average, and that gives us 17.1%. What do we need? We need a return of 8%. So the target ROE is 8%. And so let's do the difference. And again, the way I do the difference is I take what I realize minus my target, and I multiply by $1 million just because there's some rounding issues with goal seek. And so if you multiply by 1 million, it takes that out. And so all we got to do is do data, what if analysis, goal seek. Again, let me show you that. Data, what if analysis, goal seek. If you have a Mac and you're doing this, Google real fast, goal seek and a Mac. It might be exactly the same. I just can't say. But we want to set the difference equal to 0 by changing our premium. And so there we are. There we have 105.32, which was the other answer. 105.32. So if you do 105.32, your net income is 451. Your change in required capital is 177. So you'll make 274. 274 divided by 3511 is 8%. That's the premium you want. Now, what do we do with this information? Well, let's go back to the previous problem. The previous problem, what do you actually file with the state? Well, what you file with the state is you want to charge $412.73. Last year you charged $400. You take those two, divide by each other, minus 1. What you file is a rate increase. You say we want to increase our rates 3.18%. You tell the state all of this information, your investment return, your required. My job, my responsibility in all this was to come up with the investment return number, the 4%, and to come up with the required return on equity. So those were my charges, required return on equity and the investment return. The actuaries obviously did all of this other stuff. So I would be filing a 3.18% increase. What would you file with the state here? Well, here, a much higher rate increase, 105.32 divided by 100. Obviously, it's going to be 5.32%. You're asking for a 5.3% rate increase. And you might do all that work and you get 5.32, and what you file with the state is 3%. Now, why would you do that? Well, if you're filing with Georgia or with California, you might already know that the regulators are not going to give you more than 3%. You still justify that you need 5.32%, but the states will not allow you to do that. There's some states that are, we're going to talk about that, states that really regulate rates. You saw that a little bit when we did the mold issue and how states have these tiered requirements on premiums. So, you file your numbers and what you need, but then you request what you think you can get. And based on that, we think we need 5.32%, but in some states we may not file that much. Now, let's say you need 5.32, but let's say the next year, let's say you actually file. So needed is that filed, maybe you filed a 3%, because that's all you could get out of the state. But let's say next year you needed 1%, what would you file? You might file 3% again, because you did not get your 1% last year. So there's a little bit of a gaming going on here. Part of the problem is California won't let you get your 5.32, so you got to overcharge Montana and South Dakota and Texas. You got to overcharge those states to make up for what you're losing in a huge state like California. So there's some way you just have to play one state against the other. Maybe with California you undercharge on auto insurance, but you overcharge on homeowners insurance. In Texas you don't charge enough for homeowners, but you overcharge on auto. Who knows who's coming out ahead and behind. Remember, with the credit score debate, we talked about how there's a disproportionate impact, and regulators themselves may be causing a disproportionate impact because of the way they do this analysis now, or the way they approve rates. So I've given you two examples here. We'll make sure you know that you've got one here that we did the whole thing all within Excel, all in the same video. So you see how it works now, how it's all set up. It's not that, it sounds really complicated. You look at all the pieces. It's real good right now to step back and think about what we just did, what we're trying to accomplish here. And again, actuaries will put all this into one big massive formula, and it is possible to do that. You have a massive formula that solves for this 10532. I'm just keeping it simple, and we use GoalSeek. To me, it's a lot easier to do that. Or I'll give you two choices. With two choices, that may seem like a lot of work, but most of the work are these 6 cells. And remember, these 6 cells are exactly the same no matter what your premium is. All right. I do have another video that works another example. So in that one, I think I'll work it by hand on paper in case you want to see that way. So keep this one here. I don't want to give you more and more examples because it's very redundant. Every one of them is exactly the same. So if you just know the steps, you should be fine. So that brings us up to this article. Very old article. I don't even know the date it was written, but sometime in the early 90s. So this article is older than the students in the class. But it's written at a time where auto insurance was heavily in the news. So it's somewhat like when I did credit scores and then mold and storm surge. All of these have, Katrina for storm surge, mold because of the family in Dripping Springs. Here, this regulation article comes out in a time when states are absolutely being crushed by their auto insurance and just market spiraling out of control. So I'm finding these really good articles because they're written right after a major event in the industry. It doesn't mean these articles are no longer important, because what they're talking about is still an issue today, but it was written at a time where that issue was front page. And so there's still a lot for us to learn from an article this old. The world has not changed that radically. So let's walk through this article. It's written by one of the most highly respected people in the property and casualty side, David Cummings. He's a professor. He was at Wharton School. Obviously, Wharton School, that's the premier insurance and risk school out there. Very highly recognized, and I've met him once. He came and spoke. I don't know if he's still living or not. He may have. This was 30 years ago when he wrote it. I do not know who Mary Weiss is. She probably wrote most of the article, and he put his name on it because he's kind of the more, she's the assistant professor, and he's the Harry J. Lohman Professor of Insurance. But very impressive guy. So I don't know what's out there with him. I should have Googled to see if he has articles and YouTubes and those kind of things. You might even Google Mary Weiss and see what's out there. A highly respected person in the insurance field. They wrote this. I believe this article was written for Cato, so this might be one of those Cato articles. That's where I find a lot of my really, really good articles, because they tend to be very well researched, and try to be as balanced as possible. We'll see if you think this is balanced. Obviously, there's going to be somewhat of an insurance industry bent to this, but I think it's decently balanced. They try to raise the issues from both sides. So the title of the article, Regulation in Automobile Insurance Crisis, what they say they're trying to accomplish is what went wrong with auto insurance and what, if anything, can be done to solve it. They don't really, that's not really what their paper is about. Their paper is really about, is regulation the solution? At the very end, they give a solution, but it's hardly even addressed in the paper, and they just throw it out at the very end with very little discussion. So you get excited to say, hey, they're going to solve this major problem. I think you'll find it's disappointing on that question. But they imply this is what the article is about. Really, what this article is about is, does rate regulation work? And by work, does it help consumers? Does it let the industry function? Does it allow markets to function? And so that's the question they're asking. And so at the time they wrote this, the rate of inflation automobile insurance was very high. It was 10.8% when inflation was only 3.5%. So people were really upset, especially in certain states. For some drivers, the price of their insurance was starting to approach the value of their cars. It was like they're buying their car every year with just the insurance premium. So obviously people like that would be better off just not driving at all. Use public information, transportation, or get a bike or something. Consumers and consumer organizations, again, remember, these groups came up on the mold issue as well. They've targeted auto insurance as a primary source of the crisis. So they're saying it's the industry's fault. So as we go through this, make a bulleted list of what both sides are saying. But here, right here, is their main argument, and we're going to walk through these. The first they argue is inefficiency. Insurance companies are just lax in their expense management. They waste money, they have big parties, they pay people too much. This is probably the biggest one. The second one, which is antitrust or anti-competitive pricing practices. And then the last one, very similar to the inefficient management, is lax claim settlement. So I know people who actually think that is the issue. I've known people that have been in really minor fender benders, and the insurance company ended up settling for $4,000 or $5,000. And a good friend of mine, I remember he was in a really minor accident, almost no damage, and the company paid $5,000. He was really mad about that. He was like, they should have challenged it. There's no way that accident caused $5,000 in damage. But very similar to what we saw with mold. The smaller claims they pay, the bigger claims they challenge, and so they just paid it. I've had a lady hit me. She said the sun was in her eyes. I think she was actually on her phone, but I was stopped at a red light and she just barreled right in behind me. She also caused my car to hit the car in front of me. His car had no damage. Mine had a little damage. I didn't think that was that big of a deal. And so her insurance company paid for everything, and it ended up being several $1,000s. And the guy who fixed the car, he was so proud of what he did. He wanted to show me all of his great work and really get into it. And I was like, why didn't you just take a hammer and just bang it out? Because it was an old car and I didn't really care about it. So, but is that an issue? So we'll talk through those. But the most important one is this antitrust, anti-competitive practice. Does the insurance industry follow illegal actions where they're actually colluding with each other to set prices? So Proposition 103, which is one of the reasons I like this article, because this was a huge deal when this article was written. It's still around. There's still articles written on it. It could have actually been a topic for your paper 2. It's kind of late in the semester to bring that up, but paper 2, Proposition 103, and its ultimate impact, was it positive or negative for consumers? But what it did is it rolled back all auto insurance rates 20%. And it reestablished a heavy rate regulation in the states, a state that had been unregulated for decades. And they elected an insurance commissioner. And when you have an insurance commissioner who's elected, he or she is not going to run on rates need to be adequate to provide reasonable returns to insurance companies. They're going to run on the platform of, I got to cut your insurance premiums. And so here, a 20% rollback. Now, USAA challenged this in court, and the reason USAA challenged it in court is that their premiums are already more than 20% below the typical insurance premiums in the state. So they argued, why should we have to cut our rates 20% when we're already cheaper than than most of the competition by 20%? And there were several companies that did actually challenge this in court, and they did get some relief in court. But it pretty intense. The other thing Proposition 103 did, or at least there was an election shortly after this, was make it illegal for the state to for insurance companies to charge people in cities more than they charge people in rural areas. And obviously that was horrible for people in rural areas. They saw their premiums rise dramatically, and people in the cities saw their premiums drop. So again, they say, we'll examine the auto insurance problem with particular emphasis on the role of regulation as a potential solution. They don't really do that in the paper, or really at all. They're not trying to say, hey, we got this problem with auto insurance premiums, maybe regulation can fix it. They're more really the point of this article is, does rate regulation work? Insurance is very heavily regulated, one of the most regulated in the economy. Regulation can help in some instances. It can also create problems. We are a free market-based economy, so you would think regulations should only step in when there's some problem with the market system. So is there something wrong with auto insurance that lends itself to the state stepping in and saying, okay, there's something non-free market going on here, there's some anti-competitive thing going on here, we need to step in. And I still remember one of the judges during this time when all these things were going to courts, one judge made the comment that insurance companies had an interest but not a right to adequate returns. And that's about as un-American as you can get, to tell someone who's opening their business that they have an interest in making an adequate return, but they don't have a right to it. And the state wants to step in and tell them they have to change their prices, even though it means they don't get a sufficient enough return. And also the state's going to tell them that if you don't get enough return, you can't shut down your business. Once you start it, you got to stay in this business. You can't shut it down. And we're going to change your prices such that you can't make an adequate return because you have an interest in that, but you don't have a right to an adequate return. That seems incredibly un-American to me. Especially telling companies they can't shut down. Essentially telling them, hey, if you don't like auto insurance in this state, then you can shut it down, but you'll also have to shut down your homeowner's insurance and anything else you're doing in the state. You shut down your auto, we will not allow you to do any insurance in our state. That really seems to violate the U.S. Constitution and the Commerce Clause. We'll talk about that a little bit more. So we've seen this before. This is extremely important. Rates by state laws cannot be excessive, and they cannot be inadequate, and they can't be unfairly discriminatory. So excessive means they can't be too high. Inadequate means they can't be too low. But you know, when you have an elected insurance commissioner, they're almost going to completely ignore the inadequate part and just focus on rates not being excessive. We already talked about unfairly discriminatory, where we talked about credit scores and their use. Remember Gerimondi? I showed you that article, the elected insurance commissioner of California, and he says for only way you could use credit scores if you can prove that they're not discriminatory. And so obviously they are, and I really think what he meant by that is prove that they're not disproportionately impacting certain racial groups and ethnic groups. I think that's what he meant, but the way he said it, you got to prove that it's not discriminatory. Well, all of insurance is discriminatory, whether it's age or gender or type of car or driving history. Obviously, insurance by its nature is both discriminatory, and all of those are going to have disproportionate impact as well. So the last part we've already covered pretty well. So the first part, excessive or inadequate. Most states require companies to acquire some prior approval. Some states are much easier than others. There are some that essentially let insurance companies charge whatever they want to. So insurance was an issue is an issue because the inflation was so high. And you remember earlier when we talked about auto insurance, most states have some requirement that if you're going to drive a car, you must buy auto insurance of some type. Well, if the state's going to require me to buy auto insurance, but auto insurance premiums are going up 10, 11%, then my state better step in and do something to fix that. So, rate regulation became more of an issue in the 60s and 70s, became an extremely important issue as interest rates rose dramatically in the 70s, and states started saying, hey, when we set your rates, we want to see investment income. We want to see that float specifically addressed in your rate filing. Before that, that wasn't an issue because interest rates were so low. Float was not that big of a deal. But when interest rates were 13, 14, 15%, I'm not saying insurance companies weren't reflecting that in their rate making, but they weren't reporting that to the states when they were filing rates. They were ignoring the investment income piece. So we already seen the float argument. That's what this is. Insurers collect their premiums in advance of paying them out. On some liability lines, there can be a long, long time. Auto insurance tends to be a fairly short line. Before the 70s, there was no formal credit for interest income. There was no formal credit for float. So interest rates rose, and so regulators started incorporating it. It was interesting to me. We had a new CEO at UTSA. And I may have told you this story before, but it really fits here. He wanted to look at the property and casualty company solely on their underwriting. He did not want to give them any credit for investment income. And I remember telling him that, that's fine if you want to manage a company that way, but rate regulators require you to put investment income into that product. And boy, he slammed his fist on the table and said, is that true? The CFO of the insurance company was sitting there, a good friend of mine. And so he said, yeah, sorry, Bob, that's true. And he said, how can they tell me how to price my product? But they can. That's the way state laws are written. He's the CEO that was fighting for a federal charter for insurance companies. He just thought it was incredibly unfair that states could tell us how much we could charge for our rates and tell us that we had to include our investment income, that float, had earnings on float. We had to include the investment income on float in that rate filing. He came from a banking background. Banking is not as regulated when it comes to pricing. And there are some rate regulations related to how much you can charge on loans and what you pay. But for the most part, banks can charge or pay what they want to. Now, what has research shown? Research has found that premium rates tend to decline after rate regulation repeal, but what most research found was that rate regulation tends to depress premiums. So there was a little bit of indication that states step in, they harm competition, but for the most part, regulation does bring premiums down. Now the question is if that's really helping the public and really helping the market. So in states where insurance rates are heavily regulated, that tends to lower premiums below states that are competitive. So some say, well, obviously these markets aren't really competitive. If the state steps in and cuts rates 10%, and the markets function and the companies still stay there and keep doing business, then obviously it was not a competitive market, or that would not have worked. Others say that the markets are competitive, and so essentially what they're doing is the rates have been politicized, and the regulating process is simply not letting insurers make their fair profit. And so what do? They cut back on services. Here's that term availability. I did not mention availability up ahead where we were talking about excessive and adequate, but available. So insurance companies might say, okay, you're going to force us to underprice our auto insurance so that we can still sell homeowners. That's fine, but we're not going to make our auto insurance as available as it would have been. And we're going to provide less availability, worse service, so we can cut back our expenses, and in that way we'll be able to maybe get as close to our required return as possible. So let's talk about the antitrust. The effectiveness of a state's regulation has come into question. We're going to talk a little bit about McCarran-Ferguson. McCarran-Ferguson essentially exempts insurance companies from federal antitrust regulation, and so insurance antitrust regulation is entirely at the state level. So there's been some questions about maybe the states are just not as good as with antitrust as the federal government is. And maybe that's why insurance premiums are overdone. Maybe insurance companies are charging too much because states are not doing a good job of regulating antitrust. And insurance companies do some pooling of data. There are groups that put data together, especially smaller insurance companies. They too tend to share information because they don't have much data. The big guys do not. In fact, it's interesting. You as your actuarial science majors, you'll learn this very quickly in your career, especially if you work on the property and casualty side, that anytime actuaries from different companies get together, and I've seen this so many times, the first thing they'll say, this is true for conferences, this is true, I was one time where a few insurance companies came together at UTSA, and the first thing they said is, we are not here to talk about rates, we're not going to share information on rates. They just want to make it really clear there's nothing going on here related to setting insurance rates. They don't want any appearance whatsoever of any collusion going on. But some people have complained maybe states are not doing antitrust correctly. Insurance companies also have to manage solvency, so they got to make sure insurance premiums are not too low, because if they're too low, insurance companies will go insolvent. And policyholders protected from insurance insolvency by guarantee funds. That is, if your insurance company owes you a claim and they've gone insolvent, the state can go in and charge a premium to all the insurance companies that are still solvent, and they'll pay your claim. So the states can say, hey, you know what? Because we're backstopping insurance companies, we have a reason to make sure that your premiums are not inadequate. We want to make sure you're charging enough, not necessarily to make an adequate return, but you're charging enough that you don't go out of business, because we're the ones backstopping you. And if companies are not charging enough, including because the states won't allow them, you'll have more insolvencies, and those insolvencies are going to be passed on to all the other policyholders. So the states have to be careful. They get too aggressive and they don't let companies charge enough, and you have a lot of insolvencies. That's going to cause other companies have to charge more. It's going to be in their cost base. So regulators do have some obligation to protect your companies against insurer insolvencies, but that tends not to be the focus, especially if states like California that have a commissioner. You don't hear the commissioner talking about, wow, I'm really worried that insurance rates are too low and we're going to have some insolvencies. And then let's talk about this concept of market failure. A regulatory goal in insurance rate statute is that it not be unfairly discriminatory. That's absolute. So you don't want to charge policyholders a different rate when their expected losses are the same. So that part of the rate tempering, regulators come in and say, hey, we have a goal to make sure if you're going to charge Mary 20% more than you charge Sarah, then you need to have some proof that Mary is going to file more claims than the other person. I've already forgotten the other person's name. So Mary and Susan, whatever I said, or Sarah. So you got to prove that Mary is the worst driver to charge her 20% more. We saw that with the credit scoring discussion. So people who don't like the insurance industry is essentially a cost-based model. They essentially say, first, it's inaccurate. They say, and this is getting back to the credit scoring, that insurance companies don't do a good job of pigeonholing their customers based on risk. They say, hey, there's some good drivers in high risk categories, and especially in inner cities, so the rate classes are not good. Now, I do not believe that, mainly because I know actuaries that are doing this, and they have a strong incentive to get these risk groups correct. So I don't agree with that argument, and I think it's probably even less so today than it hasn't been in the past, just because the actual industry, that whole profession, has just gotten stronger and stronger and stronger over time. And they say the classes rely too heavily on proxy variables. What's a proxy variable? Well, credit scores is a good proxy variable. Something that really, what they're essentially saying is don't use age, don't use territory, don't use credit scores. Just look at their driving history. Just go on that. That's all you need. Well, that doesn't really, a young driver doesn't have much history, but we know young drivers have more accidents. The older drivers, they should charge more. So they say women on average drive less than men, so gender ratings, they're just a proxy for mileage. So just use mileage. Well, there's women who drive the same miles as men drive better than men. So mileage is not the only thing that differentiates men and women. So that argument is just very, very weak. Some people think it's just better, let's charge everybody the same. So that's what we saw in California. Residents in cities paid 4 to 5 times much as people in the suburbs and in rural areas. Let's make them all charge the same, pay the same. Well, if you do that, we're going to talk about this. It's just going to destroy the market. People in the suburbs will stop buying insurance, or they'll buy a lot less insurance, and that's just going to cause the city drivers' rates to go back up. They'll get a real quick reduction in rates, but then it'll come right back up. The same thing with credit scores and everything else. When you do not allow insurance companies to charge riskier drivers more, less risky drivers buy less insurance, and it's just going to cause rates to rise. You can't get around that. Is that fair for urban drivers? Well, they're paying their true cost. And insurance is a cost plus type of market. Economists has identified risk classification as a critical element for economic viability of the insurance system. Insurers cannot charge premiums to drivers if they can't charge based on the true risk of the driver, even if it was subsidizing. High-risk drivers are subsidized by low-risk drivers. High-risk drivers are subsidized, so they tend to buy more insurance than they need. Low-risk drivers tend to buy less insurance than they need, and you end up with what's called a market failure. That's something, at the time this article was written, you saw that in New Jersey and Massachusetts. Both states have prior approval rate regulation. It's made insurance unprofitable. Both states have engaged in rate tempering, and the voluntary market has almost ceased to exist. Essentially, the state is assigning what drivers get which insurance. So more than 50% of the drivers in each state are in what we call the residual market. That's when the state steps in and says, hey, you can't find insurance, come to us. You can't find affordable insurance, come to us, and we'll assign you to State Farm, and State Farm must charge you a rate that we dictate to them. So why don't insurers just pull out of these markets? Well, regulators essentially blackmail them and say, if you don't do auto insurance, you can't do the other insurance. You can't do workers' comp. You can't do homeowners. I really have to question why insurance companies have not taken that to the Supreme Court. It does seem like a direct contradiction to the Commerce Clause. But although companies may not be able to withdraw completely, there are other things they can do on the service side to try to offset that. So you might say, well, in most states it looks like where regulations in place, it is saving the consumer money, but the states where that rate regulation is going too far, it's caused a huge disruption to the market, and the market is essentially failing, and there's no obvious solution, because eventually insurance companies are going to be in such pain they will just leave the market. And that's the ultimate for the insurance industry, is just to leave the market. We saw that with the mold issue with homeowners insurance in Texas. You would have seen that with homeowners insurance along the coast if the courts had said insurance companies must cover storm surge. The insurance industry, at some point, a particular line of business becomes so unprofitable that they get out of the business. Or maybe what they would do is they would create an insurance company that's only New Jersey. So they'll say, okay, Allstate is getting out of the auto insurance business and homeowners. We're getting completely out of New Jersey. However, we're starting this new company called ABC New Jersey. It's a subsidiary, and they're just going to write homeowners in New Jersey. So, insurance companies can find some ways to get around this. So, how competitive or non-competitive is the insurance industry? There are a lot of insurance companies, but a lot of them are subsidiaries. So like Allstate, we'll look at Allstate and you'll see Allstate has just so many insurance companies. It's just a huge, huge, huge number. And so they're all related to Allstate. So it's really not that many companies. In some states, there's no question there, in my mind, that there's a lot of competition. I think in a state like Texas, if you want to shop around for rates on auto insurance, I think you're going to find there are companies that are fighting for your business. And this is especially true probably since this article was written, where the two newest players, Geico and Progressive, are very aggressive in how they promote. They're direct writers, so they don't have a lot of commissioned sales agents they've got to pay a lot of money to. They're very aggressive. At the time this article was written, Progressive was in the business, but they were primarily just a specialized company for high-risk drivers. In fact, UTSA used Progressive to give them our highest risk drivers. But Progressive has definitely gotten much more competitive. Geico is very competitive. And so in most states, I really think it's a competitive market. And I recommend on all insurance that you have some process, maybe once every 5 years, that you at least shop around. I have not used, Allstate has their eSurance site. Progressive has their site where you can actually go on and compare rates between companies. I haven't tried that in a while. It's a little hard to do because there's so many different ways to package the product that it's hard to know, find exactly your particular mix of parts A, B, C, and D, so that you can compare, because there's just so many different combinations. But I do think it's worth shopping around, and I do think you can save money if you shop around. But there are some states where that's not true. Now, at the time this article was written, some states like Hawaii just did not have that much competition, much lower competition. So, you have to consider that some states, if there's only 2 or 3 major players in those states, and there might be a state run, if you can, maybe it's not competitive. You would think, though, that if those states are grossly overcharging, that it'd be worthwhile to State Farm or Allstate to get into those states and be more, bring the premiums down. But it's possible. There are a few states, especially some smaller states, that may not be as competitive. So drivers with less desirable rating characteristics may tend to face limited options. So really, really weak drivers may in particular have a tough time finding insurance. Another indicator is the concentration ratio. And now these numbers have definitely changed quite dramatically. I can't get them for you, though, unfortunately. I don't have access to the databases I used to have. State Farm has historically been about 20% of the industry. They probably have dropped down some. Allstate was about 10%. The top 4 firms, they say, is 43.9, but Progressive and Geico have really increased. UTSA has been traditionally about 5%, and Farmers are about 7%. So, again, you can look at the concentration. There's something called the Herfindahl Index. Maybe you heard that in your economics class. Herfindahl Index. I forget how to spell it, but H-E-I-R-F-E. I don't know, Herfindahl. If you spell it phonetically, you'll find it. But it's pretty simple ratio. All they do is they take the market share of all the companies in an industry and they square that number. And they don't square it as a percent. They don't square 0.21, but they square 21. They square 10, and they add them up. And if the sum of those squared numbers is more than 1,000 or more than 900 or whatever, I forget if it's 1,000 or 900, you can find it at Wikipedia. then that's an industry that's considered to be overly concentrated. If it's below that amount, it's not. So I actually did this when I had data, access to the data. I calculated the Herfindahl index for the auto insurance industry, and it was below that limit, but not much. So it looked like it was an industry that's kind of concentrated, but not enough that the federal regulators, the antitrust, would say would be a concern. All right, so we'll finish up this article starting here next time. I do think there's some important stuff here. We're getting close to the end. One thing I do want to address is how you actually measure returns, which is really important. Do you use statutory numbers, GAAP numbers, market numbers? And that to me is pretty critical, because you can get really radically different answers depending on exactly how you calculate that return on equity. We saw how we did the return on equity on our case. We were really using statutory numbers, but in reality, most firms are probably using GAAP numbers with some adjustment.